Hey John, how are you doing? We're just gonna wait a little longer before we get started.
Yes, I'm doing well, Param. Thank you.
Hey John, we can start the video and just wait, give others time to hop on.
Sure thing. I'll go ahead and start sharing my screen.
Hey everybody, hey Tommy.
Hello. I almost said good morning. I'm way off here, but hello, hello.
It's been one of those days. How's everyone else doing? Nice to see everyone on here. I'm just going to give it a minute or two so that every others can hop on. Meanwhile, if you're on here, guys, drop in the chat where you're from so we can get to know you better. I feel like I know so many of you. Aven's here. Hi, Aven. John, we spoke. Hassan, Isha, Funmi, nice to see you again. Joe. we always have a few new people on here. Let me just go down the list. Mohan, Salome. Let's see. I feel like I got most of you. Awesome. And I feel like some of you were here on the first webinar we did for Colorado Springs. But if you've been to our webinars before, a lot of this is very educational. Some of you I know are completely new to investing passively in syndication. So hey, Jaren's from South Dakota. Hey, Jaren. This is, guys, this is a very educational content. A lot of you have expressed interest in the opportunity and have already booked calls with me and with the team. And so this is where we get to deep dive into everything. But like always, on the back end, we'll have tons of time for Q&A. So please make sure you're dropping all your questions in the chat, and we'll get to it on the back end. With that being said, Tommy, I feel like we're good to start.
Yes, ma'am. Let it roll.
Salome says she's from Minneapolis. I think that's Ed, Ed from Texas. Nice. I know you're from Houston, right, Ed? Nice to see you on here. Excellent. And I believe we are set up for a call later, but I'm glad we're on here. This will be super educational. That being said, let's get started, everyone. Okay. Um, Like I said, guys, the agenda today, and today, and some of you were on our first webinar, and where we always take the opportunity to go over the opportunity, talk about the risk profile, how we've de-risked it, why we think it's a great opportunity for the current market cycle. We talk about the return profile. What we're going to do today is we're also going to go over some of the numbers so you can actually see, how we're able to get the projected returns, get to those numbers, and how efficient this opportunity is, and why we think it's an excellent option to get into for the current market cycle. So I'm excited to deep dive into that. That's something we didn't do on the previous webinar. But also for those of you who've already expressed interest in the opportunity, Tommy, I think it was today, right? Tommy, you recorded a complete underwriting walkthrough video. For those of you who like us, who like to look at the numbers and really understand that, that's coming your way also. But this is like a high level overview just to help everyone understand. And as always, it's going to be, I'm going to keep it very educational. I know a lot of you, some of you are sophisticated, invest in multiple opportunities. Some of you are starting, and so we like to go down to the basics, keep it simple. But again, tons of time for Q&A on the back end. Towards the end, we'll also talk about timelines, next steps. And so with that, let's get started. And before we get started, I would like to reinforce this. Finances, personal finances are personal, and so please make sure you're talking to your financial advisors, your CPAs, and your attorneys regarding your personal situation. We do talk about tax implications. I mean, and on the back end, oftentimes we have questions, and I try to share as much as I can based on my experience and my knowledge. But we're not tax consultants, and so please make sure you're going back to your professionals, your team, and you're talking to them about your personalized situation. Also, we'll talk about numbers, we'll talk about projections. Please keep in mind that these are projections only, and there are no guarantees, and past performance is no guarantee of future results. That being said, many of you know me. I feel like I see so many familiar faces when we do this. And for those of you who don't know me, I feel like the community is constantly growing, and there are a bunch of you on here. Probably, this is probably one of the first webinars you're on. I'll take a minute to introduce myself. I'm a radiologist, Param. I'm from Southern California. And I got to financial freedom using real estate at 41, after which I felt compelled to create the community. Generational Wealth MD is a community for physicians and professionals where we talk a lot about investing in real estate as a way to accelerate your financial freedom journey. We're at about 20,000 in the community at this point. And GW Capital was what we built to allow our community to invest passively in opportunities where we've done the due diligence, we've vetted the deals, and we've grown over the years, and you can see the numbers there. But this has been a particularly difficult week for me, and I just wanted to stop for a minute. And every time we do these webinars, every time we have an opportunity, for me, I take it back to why are we doing this? What is our mission? And our mission is to help all of you get to the point where you have an income source outside of your jobs that you can rely on in times of crises. This was a tough week for me because I had a couple of friends reach out. One who was burnt out, who does a lot of mission work, travels the world, and she gives freely and generously, but she's still tied to her 9 to 5. And, and her comment was, Param, I really need to stop doing this. I want to invest and I want to scale. Unfortunately, she's not an accredited investor, so she can't invest with us passively. But the pain, the struggle is real, right? I had another friend, a really close friend, who was diagnosed with metastatic cancer. And, it just goes back to how I want all of you to be prepared if and when crisis hits. And that's the mission, right? The mission is to get all of us to the point where we have that security net for us. And so that's what we do at GW. And that's why we're passionate about this. The goal is to always, and with all the opportunities we go into, our goal is to do the due diligence, right? Vet for strategies that are lower risk, give you diversification, give you optionality, geographic diversification, diversification across market cycles, across asset classes, negotiate for higher returns for our investors, and we'll deep dive as we move on. But we're super conservative in the opportunities we get into. And when we go over the numbers today, I'll show you how and why this makes sense and why it makes sense, especially in the market cycle we're in. But then we're also very focused on making sure that the process is smooth and enjoyable for our investors, for you. Single K1s, we want to be like the Merrill Edge for syndications where, it's simplified. You not invest in 20 opportunities, getting 20 K1s. When you have questions, we're here to help walk you through it. And Tommy has supported us extensively in this. I'm here to support you guys. And it's all about giving you education so that you're empowered to do this on your own, but also helping you personalize, building your portfolio to what makes sense for you, right? Because we're all going to have different goals, and that's what we're here for. I'm going to pause and let Tommy take a minute to introduce himself also, and we'll keep moving on.
Yeah, thanks, Param. Hello, everyone. Thanks for joining us. We've got a gaggle of crazy people that like spending their evenings with us here. So I appreciate the sacrifice that everyone has made to learn a little bit more about this offering. If you're not accredited, I hope it's educational. If you are accredited, I hope you learn. At the very least, we're very much education first. So I hope you learned something today. If you find something compelling about it, we're happy to talk further on that one. But my background is actually nothing to do outside of real estate. So I was an electrical engineer for about 12 years. All the while, I'd had some success on the single family side and scaling a humble portfolio, started investing passively, and then built a business around that. Really similar timeline to Param, actually, and and that is kind of eerie. But yeah, we both been multifamily specialists. So yeah, excited to talk more about this multifamily investment.
Thank you for supporting, Tommy. These are the numbers. We're at over 2,000 multifamily units in partnership with our partners. We, for the most part, do monthly distributions. I believe this is our 16th acquisition, and we've assisted over 350 investors who've invested with us over the last few years. If you want to take a look at our portfolio, you can go to gwcapital.com, and you have all of this information over there. It's also available on the slide deck for this opportunity. But all of that is just to bring it back to the ultimate mission, which is to help all of you get to the point where your portfolios look similar to what other ultra high net worth investors portfolios looks like, where there's a balance where you have investments that are non-correlated to the stock market, alternative investments, which is real estate in this case, and the goal is to bring more resilience to your portfolios, give you a portfolio which is heavier in cash flow, so it really helps you move the needle towards financial freedom, and also bring in those tax efficiencies that you don't see with the traditional investments, right? And so that's our overall goal. Before we go into this particular opportunity, I want to talk about like the fundamentals, right? So for multifamily, which is why we're still bullish on multifamily. The majority of what we do is multifamily. We do have other assets in the portfolio, manufactured housing, but it boils down to the fact that nationwide we are in a housing shortage. That's what the numbers show. Supply is decreasing. There was a sharp drop in supply, multifamily supply hitting the markets in 2025, and it's dropping further in 2026. A lot of that is related to tariffs, increasing interest rates that happened in 2022, and so we're starting to see all of that hit us. And so the fundamentals are strong for multifamily. We're still in a place where there is a lack of we're at the worst affordability we've seen in a while, and a lot of that has to do with the fact that renting is so much cheaper in most submarkets than owning property, given property prices, given interest rates. And we are in a pro-inflationary environment with everything that the current government presidency stands for. And so this is a time you want to be invested in real assets. And so we are bullish as far as multifamily goes. And like I mentioned, the ultimate goal is to build a portfolio where you have significant cash flow, right? And that's something that you see with alternative assets more so than traditional investments, where you have those tax efficiencies. And we'll deep dive a little bit about how when you're investing in our opportunities, the cash flow that you get monthly cash flow hitting your bank account. You're not paying taxes on that because of something called bonus depreciation, right? So you have paper losses and your income is protected from taxes during the hold. And there are ways where even during exit, we wanted you to be efficient as far as taxes, capital gains goes, right? And so it's definitely more tax efficient. You're getting higher monthly cash flow, and there are ways where we can grow the value of the asset and grow your investment without really depending on market prices going up, right? And that's the beauty of investing in real estate. That's the beauty of investing in multifamily, and that's what we want to talk to you about. Now, again, I wanted to talk about the fundamentals a little bit before we deep dive into the asset per se. And this slide just is just, showing you the actual numbers, right? And this is true even for this submarket. In most places across the country, it's twice as expensive for someone to own a home than it is for them to rent, right? And that's the affordability gap. And this is why, owning real estate still makes absolute sense. It's solving part of the affordability crisis, but it also shows the strength of investing in real estate, even in the current market cycle. When you're listening to headlines, it can be very, very confusing. There's data, and there are a lot of different ways the data is interpreted. But what we like to do is to take it back to the fundamentals, and I want you to understand that as you're making these decisions, right? And like Tommy said, we're very education focused. If you guys haven't downloaded our guide, please take a moment to do so. It's gwcapital.com/guide in lowercase. This is for those of you who are getting started, and even for those of you who have been investing in syndications. If you really want to learn how you can build a buy box, be very intentional about the assets you go into, right? This way, you're doing the due diligence for yourself. If you want to figure out how to learn to vet the market, take a look at the deal, take a look at the sponsors, and really do your own due diligence. This guide even has a due diligence checklist. It's meant to help you to empower you to make better decisions, right? And so that's available to you. And again, thank you for being part of our mission. You help us with our charitable mission also, and we're really grateful for that. That being said, I want to move on to the deal. I'm going to pause. Tommy, give you a second if you want to add something before we get started.
No, I think you summed a lot up well. I'll jump in sporadically throughout the
Sounds
presentation
good.
for thoughts that are deal specific.
Feel free to unmute, and if I don't pause. But that being said, I want to do a quick overview, everyone, and then like I said, we'll deep dive. We'll talk about the returns first, and then we'll talk about the risk profile of the opportunity. And I always say this: whenever you're assessing two opportunities in real estate, it's almost it would be completely incomplete if you just looked at the return profile. So I say always look at the return profile, what's the risk profile, and that's how you compare two opportunities, and we'll do that. But high level overview, what we love about this deal, we're getting it at a great discount, right? We're getting it at $2.5 million discount because of our relationship with the sellers. It's always important to buy right, and this is again one of those cases. And if you look at the business plan, you'll hear me say this over and over again. Consistently, right, over the last few years, we've tried to get into opportunities, and I always say the safety is when you have high cash flow day one, right? And so this is not we're going to execute a business plan at the end of year one, we'll have cash flow. No, we go into opportunities, and Tommy and I take a lot of time to actually stress test these deals to make sure the numbers are conservative, But we try to go into opportunities where going in day one, you're having significant cash flow, right? This is another one of those opportunities. And what that does is that even in this economy, it gives us a buffer, right? A buffer of safety. And the second piece to that puzzle is having a business plan that doesn't really, like in this market cycle, it's hard to go in and bump up rents, right? So if you've noticed, and this is true in the single family space, it's also true in multifamily, in most markets, right? The way the economy is, with the uncertainty, it's hard to push rents up significantly, unlike say 3 years ago, right? And so the business plan kind of has to tailor itself to the market cycle, and that's what you're going to see here. And we actually have slides. I'm going to deep dive into it, but it's very much a plan where we're leaning into operational efficiencies, right? And the best part about this deal is that within a 10-mile radius, our operators on the ground, they have about 1,400 units. So we have economies of scale, right? And that's what's allowing us to significantly increase our income from the property, right? Our net operating income, which is income minus expenses, allowing us to execute the business plan and allowing us to get significantly higher returns with a very low risk strategy. And so love that. It's a newer vintage. It's a 2003 asset, right? It's within 15 minutes from this property, there are the new Apple and NVIDIA AI supercomputer campuses are being developed. And in 2026, we anticipate over 3,000 new jobs just from those factories, right? And so whenever we're looking at a market to go into, we want to go into a place where there's a lot of growth, a lot of job growth, which means there's a lot of migration. And then if there's a lot of migration, but there isn't a lot of supply in the area, then we're positioned for success, right? And supply is something we look at, especially in this current market cycle. A lot of submarkets are struggling because there's a lot of supply. And the great part about this asset is that within a 3-mile radius, there's zero supply, right? In the next few years. And so great growth and very low supply, a great basis for entry, and a very low risk business plan. And the combination is what we look for. And it's been hard to get that in this market cycle, but this is one of those opportunities where all the boxes were checked. And so that's just a high level overview for those of you who are trying to get the bigger picture before we deep dive. But with that, I want to move into the return profiles. And you've probably seen us mention this in emails. The returns are higher for GW investors, and we do our best to negotiate that. And we were able to do it for this opportunity. I want to deep dive. Tommy, am I good to go ahead? Do you want to pause?
Please. Yeah, keep going.
So, guys, some of you already know what this means, but I will take a second to explain this. One of the things we did for GW investors compared to retail investors with this opportunity is that we were able to bump up preferred returns from 7% to 9%. What does that mean? So you have two things so you have cash flow when you hold the opportunity, right? And so cash flow for this opportunity is about 6%, which means on average, you're getting anywhere from 4 to 8% in cash flow hitting your bank account every month. And like I said, that's going to be tax-free. Now, a 9% preferred return just means that for every year that you're in the deal, between a combination of the cash flow that you're getting during the whole period and what's accruing on the back end, we want you to have 9% for returns for every year that you're in the deal on the back end before the profit is split, right? So the first 9% goes to our investors as opposed to 7% for retail investors before the profit split is calculated. So that is a safer return profile for you as the investor because you're getting those returns first before the operators, the general partners, have any stake in it, and that's what we were able to negotiate. So that's significant, and this is the return profile for our investors. And so 9% preferred return, higher increase from 7% for retail investors. The profit split on the back end. So whenever we exit, you have return of capital to our investor. The lender gets paid. Then we return capital to our investors, and we are making sure they hit their preferred return. And after that, the profit split is calculated. We were able to negotiate a higher profit split we are giving our investors a higher profit split than retail investors. So it's up to 75-25 compared to 70-30. And then with larger check sizes, your returns do get enhanced. And so again, in all of these categories, you're getting a higher profit split, right, compared to retail investors for a lower investment. And so GW investors do get higher returns, no matter what class they're in, and they do have a lower minimum investment to get into the opportunity, which is 50,000 as opposed to 100,000 for retail investors. And for those of you thinking, okay, so what does that translate into in terms of dollars returned? What can I expect, from monthly cash flow over the years, and what can I expect on the back end? That's where these numbers come into play. And so I would say, Adrian, if you can drop a link to the opportunity in the chat, guys, this is also available in the slide deck if you want to take a look at it. You can. And then again, for those of you who are more specific, want to say, okay, what are my average returns looking like? What are my average annualized returns, IRR numbers, equity multiple, all of that's available in the slide deck also. But just to explain this for those of you who haven't seen this slide previously, cash and cash is your cash flow that's hitting your bank account, right? So these are the monthly distributions. This is from cash flow that we get from the property. If you're looking at comparing this to say, if you're looking to compare this to your stock portfolio, the average annualized returns, that's a great metric to use to compare your real estate returns to your stock portfolio. And it's, on average over the life of the investment. So if we're hoping to double your capital over time, right? So you invest 100K on the back end at the end of the whole period between cash flow and increase in the property value over time. If you're doubling your money, right, that's on average about 20, or for a 5-year hold, that's a 20% average annualized return, right? Simple, that's where that number comes from. IRR is internal rate of return. Now, that's a metric similar to AAR, but it factors in time value of money, right? So it factors in when the capital is returned to you over that 5-year period, because there's value to that, right? And so when you're comparing two real estate investments, it's valuable to take a look at the IRR, right? That's a great metric to use. It's lower than AAR because in this case, a lot of the return is on the back end, right? You do get cash flow, but the bulk is on the back end, and that's why that number is lower. But it factors in time value when the capital is returned over the whole period, right? Equity multiple is just like, hey, how much are you doubling, or what is the multiple of your capital over the whole period? And that's what it is. And so you'll see that those numbers increase with the higher classes. That's because you get enhanced economics. And then the distribution waterfall is also how that capital is returned to you. And it's a great slide to take a look at if you want to understand this in depth. And so with that being said, so that's what you're getting. I wanted to pause and talk a little bit about how we're actually executing this business plan for those numbers to happen. And like I mentioned, Tommy just recorded an underwriting video, and we're going to be sending that out next week to those of you who really want to take a look at the spreadsheet, what the assumptions are, what did income look like before, how are we hoping to bump it up, what's happening with expenses. I just wanted to go over the expense portion of that to show you how we add value in multifamily and how this business plan is really, really conservative. But before I go in depth, Tommy, I'm going to pause, see if you want to add anything else.
Yeah, I guess just on the topic of slides, do you mind going back to the annual projections here a little? And so I did want to touch on kind of the concept of the return profile here. You can go to the annual projections, Param. And so really I'm sorry, if you don't mind doing the year by year breakout.
The year by year breakout.
The previous slide.
Okay.
Yes, ma'am. Thank you. And so really the main point I want to emphasize here is, some of the questions are, how are we going to get to doubling my money in 5 years, right? We're, ideally that would be a 2x equity multiple. We're at 1.98, so still pretty good. But in terms of the types of returns that you can expect, there's going to be two forms. So there's one form is going to be the distributions that you get over the life of the hold. This is excess cash flow income minus expenses minus debt service. And then the excess cash flow is shared with investors pro rata by their ownership percentage. And so you would expect a little bit of cash flow over the life of the hold. For this project, we will be doing monthly distributions. Distributions would start May. And But what I want to reiterate here is in our underwriting, we're basically allowing ourselves 24 months to get up to pro forma, which is why you would expect a little bit more of a compressed cash flow profile than say the latter 3 years. But in general, our projects float between 4 to 7% on any given year. Obviously, 4 being more on the year of acquisition, and 7 being the year where we do expect to offload the asset. And so this really is kind of on par with a lot of our other projects. And if you're asking what our criteria is for projects here, we're trying to target projects where we can double your money in 5 years in a responsible way. And our investment thesis has evolved over time to just being sourcing for projects that are more cash flow heavy at the onset, and sacrificing a little bit of equity appreciation. But this particular deal, you'll notice that the net proceeds from sale far exceed the cash flow. So yes, there is a little bit of cash flow when we're talking about passive income streams and things like that. But in terms of if it's right for your portfolio, this does resemble more of a growth profile product with a little bit of cash flow on the way. So I just wanted to reiterate that to make sure it aligned with people's portfolios and investment goals.
Thank you, Tommy. Okay, that being said, let's look at the numbers. So I'm going to zoom out a little bit first, just to give everyone an idea of how, how numbers work as far as commercial real estate goes, right? And so this is something that you're going to get when you get the email with that you'll get access to the spreadsheet to also get access to the underwriting videos. But I'm going to go over how we have about 400K in savings in expenses compared to what the asset is currently, what the expenses are currently versus what year one looks like, right? And that factors in property tax increase. Factors in insurance costs going up, right? So factors all of that. Despite all of that, we're getting a 400K savings as far as expenses go, and I'm going to talk about it. But I want to talk a little bit first about how that translates to value add, right? And it goes back to the basic concept that an asset value as far as commercial real estate, which is very different from single family, right? Because in single family, you're basically your price goes up. It's based on what the demand is and what your neighbor's home sold for, right? Very different from commercial real estate, where asset value is dependent on two factors, right? One is net operating income, which is your income minus expenses, right? So that's net operating income. And then the next one is cap rate, which is, what's the market cycle looking like, and how much is someone willing to pay for a property in that part of the market cycle, right? So these are two variables. And let's assume a 5 cap, which is what I've done for this example. If we're increasing the net operating income, which is income minus expenses, by 400,000, you're actually increasing the asset value by about 8 million. Right. And so I'm going to show you what that looks like for this particular asset. And while I talk about it, I also want to mention that, a lot of these numbers, our partners on the ground, they own the sister asset to the Preserve at Copper Springs, which is Preserve Copperleaf, where they've executed the same strategy, right? And that property is currently at 97% occupancy, 18 months. And again, like I said, this is not the business plan for this asset, but I just want to give you an example of what the team has been able to execute on the ground in that submarket, in that neighborhood, right? Within 18 months of acquisition, they were able to do refi and return 45% of investor capital, right? Now, that's not the business plan for this asset, right? And it doesn't mean it can be done. But what it shows is that a big part of that, the reason that was they were able to do that and maintain that high occupancy is because of the property management team, right? And once this asset is acquired, we're going to be sharing assets across the team across both assets. And so this isn't hypothetical. This is something that has been executed at the sister property. And so it just talks about how valid these numbers actually are. But that being said, let's take a look at the actual numbers, right? And so high level, if you zoom out, you can see that, trailing is what the last 12 months have looked like, right? Last 12 months, we're at the property total expenses were at about 3.87 million, and anticipated expenses in year one of acquisition are close to under 3.5 million, right? And that's where the discrepancy is. And so how is that happening? You can see the actual line items. So payroll, and again, a big part of this has to do with bonuses and benefits that the current team is getting paid versus what the new team will get paid. Contract services, a lot of a big part of the contract services is bringing in in-house valet trash, which actually gets added to the payroll line, on-site security, which where they get to stay on the property, right? And so the cost for the services are reduced significantly. So a lot of different line items. And again, this goes back to why it's important to have economies of scale in the submarket and how that really benefits the property. But you'll notice that with each of these line items, even though insurance costs are going up, overall we're able to achieve close to a 400K drop in expenses, which again all gets factored into the net operating income. And so you'll see that a big part of the value add, and when we talk about commercial real estate, or even, if you've heard me talk about the BRRRR strategy for single family, a big part of why real estate is so attractive to the sophisticated investor is because you're not at the mercy of market changes, right? And so you're not at the mercy, entirely at the mercy of the market cycle we're in and what asset values are, what cap rates are. You do have control over both tax efficiencies, right? And that's something that you get across market cycles. We're at a place where we have 100% bonus depreciation. I'll show you what the tax savings look like for this asset. That's something we have control over. And then we also have control over this, which is what we call value add, where you're increasing the asset's value without really waiting for the market cycle to shift or inflation to cause asset values to go up. And so there's control in value add. And over here, you're seeing a scenario where the value add is not from like extensive rehabs, which would require deployment of a lot of capital, but this is a very strategic value add where a big part of the value add comes from operational efficiencies, which is critical for this market cycle, right? And so I'm sure Tommy can share more about this. But the last few years, it has been the year of the operator. A lot of the efficiencies, the smart way to do it is to be creative about value add. We've done this with property tax exemptions in some of our properties in Houston, and we've done it with operational efficiencies. If you look at the monthly reporting for some of our recent acquisitions in Houston, you'll notice that we're actually far exceeding the lowering of expenses in the assets that we acquired, right? And so it just talks about the strength of operations, and it talks about a strategy that works in the current market cycle, but without adding on risk by actually significantly lowering risk. And so that's what I wanted to highlight over here. Tommy, I'm going to pause, let you add some more color, and then we can move on.
Sure. Yeah, I appreciate that. And it's not really so, and I guess I'll touch on income before I go into expenses, but the year-over-year increase line was actually representative of the income section. But right, we're talking low single digits for the year-over-year increase in income. Like the name of the game isn't to jack up rents and piss people off and hope they don't move out, right? There, we are going to be incorporating an amenity fee, which would be a kind of a quality life increase because that would allow the entire apartment complex to get access to Wi-Fi. And so, yeah, in terms of the expenses, right, we could probably go further with expense reduction. It's a balance because what we don't want to sacrifice is quality of life and quality of operations. But the other thing I want to mention here in terms of the difference between the expenses of the trailing and what we anticipate to be by the end of year one is that it's not so much an expense reduction as much as it is like an expense normalization, right? That we have a property just like this, less than 3 miles away, and we're putting in, some of these per square foot per unit numbers, normalizing it to this property. And that is how we are coming up. So very, very real world numbers being applied here. This isn't just, we're not getting quotes from contractors and hoping that we can get a 10% discount if we pay up front or anything cute like that, right? So these are very real numbers, and it all stems from being market focused, and having the right boots on the ground partner. So.
Oh, thank you so much, Tommy, for pointing this out. When I did the screenshot, I included this row, guys, which, as Tommy correctly pointed out, this is for income growth, right? So this is from the previous rows. This is just the over year increases for income growth. What you're looking at over here is the total operating expenses over here, where you can see it drop, and you can see the drop, in the percentage over here. That's what I want you to be taking a look at. And then again, you have the net operating income and how that's expected to grow over the hold. So thank you for pointing that out, Tommy.
Sure.
Excellent. Okay, guys. So now we've talked about the return profile. We've talked a little bit about the business plan. But what I want to do next is I like to walk everyone through the vetting process, which is okay, what does risk look like, right? And so when we do that, I usually like to talk about the market first, and we'll talk about the property per se, and then we'll talk about the business plan. And so let's do that. When we talk about the market, again, if you've invested in syndications, you guys know that it's very sub-market driven, right? And so yes, we have some data about the Houston market per se, but it's really, really important to take a look at that sub-market, the neighborhood, to see what the demographics look like over there. And what we love about this sub-market is that it has strong absorption, which I think is really important. And a part of that also probably has to do with the low supply that we're seeing. It is a supply constrained sub-market. That's something we're very, very intentional about in we have been over our acquisitions over the last year, and that's because a lot of really strong markets are getting hit with a lot of supply, and that's lowering occupancy, increasing vacancy, and it's causing rent growth to plateau or lower. And so this becomes really, really important, especially in the current market cycle. And so it's a supply constrained submarket. There is no new supply within 3 to 4 miles, strong absorption, great schools. Another thing we like to look at is what is the average household income, because this also dictates people's ability to pay rents, to absorb the rent bumps that we have. It also factors into delinquency, and so really, really healthy numbers. Typically, if it's for the rents that we have, which is about 1,500, anything over 80,000 is a in terms of average household income, is a healthy number, and we're at close to 120,000. So just talks about the strength of the submarket per se. And like I mentioned, owning in this submarket is almost twice as expensive as renting, right? And then again, you're always looking at what are the industrial, what is industry diversification looking like, right? And so what are the magnets in terms of jobs? And there's easy access to the energy corridor, but I think the highlight is again the new Apple and NVIDIA super factories that are being developed within a 15-minute drive from the property, and that's going to add a ton of jobs, over 3,000 projected jobs in 2026. You have all of this in the slide. We've talked about this in previous webinars. Houston per se has strong demographics. It's a very strong market for both job growth, population growth. But like I said, I think that the key is to take a look at the submarket because each submarket functions differently, and the submarket demographics are really, really strong. Tommy, I'm going to pause if you want to talk a little bit about the Houston market overview.
Yeah, I mean, Houston's been in just about every top 10 article related to real estate markets over what, like 3, 4, 5 years. It's no secret that people are moving to Texas, right? They enjoy the lack of state income tax. Same for Florida. So Texas and Florida have always been number one and number two. Texas, just given its size, more people are moving to Texas. So nominally speaking, Texas will be number one for darn near forever. But as far as the submarket goes, you're right. It is location, location, location. And as much as we like Houston, right, we got to mind the pockets. So being on the northwest side near the energy corridor, right, you can see that you've got two of the best companies in the world that are expanding and moving into this market with NVIDIA and Apple. That's going to do really good things for average income, but also given the supply constraints with regards to housing, like that they're going to have to rent before they can own there in the submarket there. So we're happy to be close to it. Being one of the best school districts in the nation does not suck, and very much supports that demographic there. And I don't know if it's on one of the investment overview slides, but the over half of the floor plans in this apartment complex are 2 beds and 3 beds. So we were very well suited to suit families. So I think we're positioned rather strongly.
Thank you, Tommy. And guys, like I mentioned previously, the average cost to rent in the submarket is 1,350 versus 2,820 to own. And so you can see that it's almost half as expensive. And so again, it really affects the decision making. A lot of the overview slides are in your slide deck also. Again, just another slide to show how, like Tommy mentioned, a lot of migration happening, a lot of population growth happening in Texas per se. And so again, over the last decade, it's topped the population growth charts. I think most years. But that being said, let's talk about the property, right? So we talked about the submarket, and that's important. What's great about the property? Like I said, we're acquiring it at a great basis, and a big part of positioning ourselves for success, going in with built-in equity, is getting in at a good basis. So $2.5 million discount. The seller is forced to sell because of loan maturity, and our partners have an existing relationship with the seller. They acquired a sister property, and so we were able to negotiate a solid discount over there. Again, 2003 vintage institutional quality asset. So usually with older assets, there's a lot in terms of deferred maintenance and unexpected capital expenditure that you can expect to see in the first few years of ownership. Now, this is not that kind of asset. The seller has already put in over $1 million towards capital improvements, so not a lot of deferred expenses. The asset has had approximately 95% occupancy over the last few years. And if you guys have been following the last few years, occupancy has dropped in most submarkets. And so this is very, very strong and healthy. And again, we have efficiencies of scale just because of our partners, boots on the ground, owning properties in the area. This is not one of those properties where a lot of the units need to be renovated. They already have premium interiors, granite countertops, black appliances, and so not really a lot of work that needs to go in. And great amenities. This is something that obviously tenants are looking for. Just makes it an institutional quality asset, giving us a lot of exit options on the back end. I'm going to move into the business plan. Tommy, do you want me to pause before we go?
No, not really. The only thing I'll say here is that if you look at these amenities for this interior and exterior and for the entire community, it's on par with something that's built brand new. So we're not lagging behind with 1980s vintage and trying to put lipstick on a pig or anything like that. Like this is a solid asset, solid amenities, and it's very attractive.
Thank you. Okay, the business plan, and we've talked about this over and over again, and I feel like if you're learning and educating, especially in this market cycle, like understanding the submarket is really important. Going into a really strong asset is really important, but the biggest piece of the puzzle that really sets us up for success is having a business plan that's conservative, right? So strategic value add, like I talked about, going in, and having a plan that doesn't have aggressive assumptions is really, really important. Like I said, our partners have already executed the same business plan with the sister property, and that's really, really important. The big part of the play over here is expense optimization, which is something we have control over. And so it's not based on aggressive rent bumps, which would be hard to execute once we got in there, right? So this is based on a plan that has already been executed, and you can see how the NOI increase of about close to 20%, is just a very conservative assumption in this case, right? And big part is based on cost savings, but there's also revenue optimization. There is an amenity fee that is hoped to be rolled out, and that is based on valet trash and bulk Wi-Fi. And again, it's a plan that has been executed in the sister property. So it is a very, very conservative assumptions over there. We talked about supply constraints, and I mentioned how it's really important for any asset that you're looking at in this market cycle, especially commercial properties, to make sure you understand supply. And this is a submarket with strong absorption and great employment and lots of migration happening. I wanted to point out for those of you who have been to a lot of these webinars, when we're looking at how conservative the plan is, the number we like to look at is what is current occupancy, but also what's break-even occupancy. And break-even occupancy is how much occupancy needs to drop for us to not be able to make the debt service payment, right? And so this is why we go into assets that have strong cash flow day one, because it gives you that buffer, right? And so when you're looking at things like DSCR, which is debt service coverage ratio, or break-even occupancy, the simplest way of looking at it is they're all a feature of, and so cash flow, day one cash flow is, really is a way of looking at that, is a better way of looking at it, right? So it's reflective of how much cash flow you have day one, which is your buffer. And so what it means is that for this asset that's currently at 94, 95% occupancy needs to drop to under 70% right? So that's a significant drop in occupancy for us to not be able to make the debt payment. So that's what break-even occupancy means. This number over here, currently rents are at 1,500, and they're going to get bumped up by just a tiny smidge. And this is important because it just shows you again how conservative the business plan is. The plan isn't to go and bump up rents, which is really hard to do in the current economic cycle, right? So again, it's a very conservative plan based heavily on expense optimization. So that's what I had to mention over here. And like I said, so Valley Trash and bulk Wi-Fi, those are the amenity fees that will be added on, right? Which will bump up the income a little bit. The other thing that you really want to be intentional about in any market cycle, but especially in times like this, in the part of the market cycle we're in, is the debt that we're assuming. And again, over here we have fixed interest rate agency debt for over 7 years. So this is a very low risk debt product that we have, which if I were to pick two things, if you were to go and assess an opportunity in the current market cycle, if there were two things that I really wanted you to focus on, it would be debt and day one cash flow. And so just shows you how conservative the business plan is, right? We worked with the team before. These are, that's just our partners on the ground and other partners in the opportunity. But just as I wrap up the business plan, right? For those of you who've seen the slide before, you understand what it is. But I just want to mention this again. This is a slide where we talk about return profile and risk, right? And so whenever you're assessing passive investment opportunities or any real estate or alternative investment opportunities, you're looking at both risk and returns. And new development typically is high risk, higher return. Core assets are brand new buildings where the risk is much lower, but the returns are also lower. And usually we try to stay in that value add area where you're adding value to a property, right? But it's already stabilized. You're going in and there's cash flow. It's occupied, right? You're not leasing up or anything like that. This is where we like to stay, and it's moderate returns, moderate risk. And core plus assets are assets like the one we have. Like the Preserve at Copper Spring is a core plus asset. It's not an asset where we're going in and dumping a ton of capital to bump up rents. We're not doing massive rehabs. So it is a core plus asset. It's a 2003 vintage. The business plan, right, which we talked about, that expense optimization, that's what's allowing us to bump up returns. So this is where we are with this asset. So essentially, and you've probably seen the slide over and over again if you've been investing with us over the last few years. But this is what we're striving for. Getting into core plus assets, but getting those value add returns because of creative, strategic value add. I'm going to pause, Tommy, if you want to talk a little bit.
Sure. Yeah, I think it's you touched on the low break even occupancy. I think a lot of that has to do with it being a function of the debt. On the previous slide there, we kind of referenced some of the terms that we're getting. So we're 65% loan to value, which is, I would say, notably below average for the industry. Because it's easier to show higher returns the higher your leverage is. So for us to have this low a leverage and be able to generate, close to our target investment criteria of trying to double your money in 5 years, that's very much a testament to the amount of value we plan to add on this one. This is a 7 years in term. We are getting several years of interest only. The interest rate right now is 5.3, although there has been plenty of precedent where it has been notably lower by the time that we close. The last thing I will say was that the amortization period was 35 years. I don't think this is talked about enough, but like if you bought your home, right, it was probably 30 years amortization. Most of our acquisitions actually, they land on 30 years amortization because we do fixed rate debt with Fannie Mae, Freddie Mac products. But to get 35 years, that actually is a little bit of relief on the monthly liability we have to our lender. And so that does help out the cash flow notably to have that. There is such a thing as 40-year amortization in the commercial real estate space. It is typically reserved for nonprofits or like low income housing, tax credits, projects, and things like that. But yeah, very atypical to see 35 years. So there's a number of things that are very specific to the team, the relationships that they have with different vendors, lenders, brokers, that all kind of culminated to this opportunity to really make it kind of, hard to replicate and duplicate with any other operator.
Thank you, Tommy. So as we wrap up, I just want to talk about rent comps and sales comps for those of you who are used to looking at this as something you want to take a look at. And it just rent comps just tell us compared to similar properties in the area, where are we in terms of rent? And you can see that we are, lower than the average, which is a good thing, which means that the business plan is viable. It's not an aggressive plan. Same thing if you're looking at sales comps for similar properties, you'll see that the per unit price is significantly lower. A big part of that is because of the discount, but also negotiating a good price. And so this is something you want to look at just to make sure that the plan makes sense, and all of that data is available for you in the slide deck. Okay, moving on to the tax savings. Many of you remember last year we started the year at, I think it was 40% bonus depreciation, and then went up to 100% bonus depreciation. So that just means that with the new presidency, we went back to the really advantageous tax losses that we were able to take as real estate investors. And again, for the same thing for this particular asset, with 100K invested, you're getting about 52,000. And so again, these numbers can fluctuate when the actual studies are done after acquisition. They can fluctuate a little bit, but approximately, a little over 50,000 in passive losses for every 100K invested. And so this is the reason why when you're investing, in this asset and you keep getting monthly distribution that hits your bank account, you will not see, you don't have to pay taxes on it because on paper you have these losses that offset the taxes. And so this is what makes it very tax efficient. And then, like I mentioned, on the back end, with these opportunities, and again, it's not guaranteed, but we'll always, our goal is to have an opportunity lined up where you're able to do a 1031 exchange into the next opportunity. Now, unlike your direct ownership real estate where you can 1031 into any other opportunity, with syndications, because you don't own the property, you have shares in the property, the entire LLC 1031s into the next asset, and we can always talk more about that if we need to. But it does give you the ability to roll your capital into the next opportunity while being tax efficient without having to pay capital gains, by allowing you to defer having to pay capital gains, defer having to pay depreciation recapture. So it's very tax efficient at exit. There are ways to strategize around that. And I mean, and then the point of the slide is to just show you how when you are really tax efficient, and you don't have that tax drag over time, that starts compounding. And this is how you're able to build generational wealth. I'm going to pause, Tommy, if you want to talk a little.
No, I think you're good, right? It's a compound effect versus not compound effect. I think we're good to move on.
Absolutely. And so the question always comes down to, can I use my tax savings? If you have any specific questions about this, we can talk about it. The losses that you get with this opportunity are going to be passive losses, which means you can use them against any distributions from the opportunity and against any gains or recapture you have on any other real estate assets that you're exiting, or any other source of passive income you have. So many different ways to strategize around this, especially for those of you who have other sources of passive income or have other real estate investments. And so I always say, please make sure you talk to your CPA ahead of time so you can really strategize and you understand what your tax implications are. And then if you have specific questions, I'll try to take them on the back end and answer to the best of my ability. Okay, so finally, it's a deal conservative. It's kind of a wrap up of a lot of what we've been talking about, right? And so we always say this, like, how have we de-risked the opportunity for the current market cycle? And like I said, acquiring this at a great basis, right? Having really conservative debt on the asset. Having strong cash flow, and like I said, the break-even occupancy being 69%, having a strong DSCR going in just means the debt service coverage ratio is a ratio between your net operating income and how much debt you're paying annually. And so we really want the cash flow from the asset to be higher than the annual debt payment, and anything above 1.25 is healthy, and so it's stronger for this asset. And so these are all just functions of the cash flow, right? And that's something that we really look for as we're vetting these opportunities. Again, it's a core plus. business plan, like I showed you, where it is an asset that doesn't require a ton of work, but you are still getting value add returns because of that expense optimization. And then, like I said, the economies of scale, vertically integrated operation just gives us more control over the business plan. Again, supply, going into a supply constrained market, which has ton of demand, great, job growth. That's really important. And then, no deferred maintenance because the sellers have actually put in over $1 million, towards capital expenditures. Why invest now? And this is a question. For those of you who are following the real estate market, you know that March 2022 was what we call the peak of the market cycle. That's when there was a lot of interest in investing in real estate. It was also a time of maximum risk. Right now, I would say we're on trending upwards, right? But it is also a time where, you don't see the same excitement because there's a lot of uncertainty in the economy. But it's also a time where we're getting these discounted assets where there is more opportunity in the market cycle, and that's what the fundamentals are. This slide just shows you how when you acquire assets at a great basis, that's when we're able to get outsized returns, right? And so that's where we are as far as the market cycle goes. And that's what I want to highlight. So you have the ability to kind of lean into it. Now, this slide just shows what is expected in terms of multifamily asset values, right, over time. So as interest rates drop, there's a correlation. Asset values tend to increase. A big part in terms of occupancy and rent growth. A lot of that also has to do with supply, and you can see that 2025, 2026, you're seeing a steep drop in supply in most submarkets, and that also strengthens both occupancy and rent growth. And so we talk about fundamentals at the beginning. I'm just going to highlight that again. This is a time where we're getting highly discounted assets. Rates are dropping. Asset values will increase. We are in a pro-inflationary environment. We are at a point where housing affordability is at its lowest, which means there's a strong demand for multifamily housing. And nationwide, if we're looking at, long-term fundamentals, we are in a housing shortage. And with construction slowing, we will remain in an environment where we are in a housing shortage, and therefore the fundamentals for the long-term fundamentals for multifamily is very strong. Tommy, do you want me? I'm just going to pause. Anything to add over here before we move on?
No, I think it was well said.
And so our partners on the ground are Lone Star Capital. Their track record is available in the slide deck. If you want to take a look at it, our portfolio is in there also. If you're thinking about next steps and timelines, this is a 506c. Our fund, GW Capital Fund 1, is a 506c fund. And this opportunity does require you to be an accredited investor. What that means is that for the last 2 years as an individual, you should have had 200,000 in income, or combined with your spouse, 300,000 in income over the last 2 years, or you have a net worth exceeding $1 million, excluding the value of your primary residence. That is a requirement for the opportunity. The last date of soft commit is February 10. We start filling up fast, and so we always think it's best to submit a soft commit as soon as possible. So you're holding your spot in line, and it's non-binding, and it just holds your spot in line. Adrian, if you can drop a link to the opportunity again in chat, so everyone can have the ability to go in there and submit their soft commit. The funding deadline is February 18th. March 13th is the closing date, and then if anything shifts, we'll be notifying you via email. Adrian, if you can also drop a link for booking a call with the team in there, that'd be great. And so you can book a call with me, and we can go over the opportunity and if it makes sense for your portfolio. More than happy. I think I've set up calls with many of you over the next few days, and we'll be chatting. But if you do want to have specific questions answered, really want to see if this is a great fit for your portfolio, then Adrian, please drop the link in chat and on Facebook. So anyone who wants to set up a call, feel free to set up a call with me. That being said, we're going to wrap up. Tommy, anything to add? I just have some questions that we get asked quite a bit over here, and we can take those first and then go into the questions in chat.
That works. I don't know if there's a slide for why the seller is selling, but that's probably a fun story to touch on.
Yeah, you can touch upon it now, Tommy. I can
Sure.
skip past the slide later.
Yeah, I'll jump into it. So yeah, I think one question that we've gotten asked very often is why is the seller selling? And it's a prudent question to ask. I think every investor should ask that if they're unaware. But so the what we don't want to hear is that, oh, this is a distressed asset or there's skeletons in a closet and they're trying to get out of it. But the reality is this: the seller, they bought in 2016, they bought with a 10-year note and is coming due. And so we have gotten the probably almost all of our discounts over the past year, not because of price, but because of a surety to close. So we've done transactions with this broker, with this seller, also in the same market, just down the street. And so yeah, a surety to close is more valuable to sellers nowadays, especially that have impending loan maturities coming due. And so, yeah, there is a little bit of benefit by us being positioned the way that we are, but they could consider refinancing and holding on to it. But the reality is they have velocity of capital to mind. I mean, this is one of the largest private REITs that we're talking about that's selling it to us, and so they don't want to just refinance and let their money sit for another 10 years, right? They want to move it into other projects, which is very, very normal, right? In organic, I would say. And so, yeah, there's not any underlying problems associated with the property, especially given that we've bought from them. They're also one of the top 10 real estate operators in the nation. So yeah, we don't expect any sizable surprises upon acquisition, and there's no gotcha associated with the sale, which is refreshing.
Thank you, Tommy. I want to talk a little bit about GW Capital Fund One. We transitioned to the fund model in 2024. And the reason we did it is because we wanted to be able to negotiate better returns for investors while giving you diversification and giving our investors a single K1 at the end of the day, which can be, a big relief. But a big part of the fund is also that it's a customizable fund or a flexible fund, which means you get to pick and choose which asset you go into. You get to do your own due diligence and you get to decide how much you put into it, right? And so that's the best part where you're able to invest in it as though you were investing into a single asset, but you have all the efficiencies of investing via a fund. So it's not a blind fund, it's completely customizable. And the goal has been to give you diversification, give you options while making the process simple for you. So this was the slide that you took care of, Tommy. Distributions will start in May for anyone in this opportunity. That's because April will be the first full month of acquisition. And so April's distributions will hit your bank accounts in May. Like I mentioned, Tommy has recorded the underwriting video and he'll be sending that to everyone. And the whole term, expected whole term is about 5 years. And we say about 5 years because, well, we have a debt product that's for 7 years. And usually we target, when we say five, it's about 3 to 7 years. And exit will depend on, the ability to execute NOI growth. But more importantly, where interest rates are, what market cap rates are, right? Which part of the market cycle we're in. And so we usually underwrite for 5 years because that's a good average to target. The minimum investment amount is $50,000 for our investors. You can use IRA funds. I will say that if you have funds outside of your IRA, then that's a good place to start just because you don't want to put a tax efficient investment into a tax deferred vehicle. But for the majority of us, if you have a ton of if you're like the majority, you have a ton of capital in your IRA, and if you're looking to shift your asset allocation, then you may need to invest via your IRA. And if that's what you're looking to do, then you can email us at admin@gwcapital.com and we can connect you to our IRA custodians who can assist you if you don't have a custodian. Do you need an LLC? You don't necessarily need one. I would say the majority of our investors invest without an LLC because the limited liability that is already offered by the LLC that the asset is in. So as a limited partner, you already have a limited liability. That being said, please talk to your attorneys. We do have investors who love investing via an LLC for multiple reasons, add a layer of protection, keeping it separate from their personal tax returns. So there could be reasons why you'd want to invest via an LLC. Please talk to your attorneys. And the GPs have multiple six figures in equity in the deal, in addition to what the LPs are investing. Those are questions we've gotten quite a bit over the last few days. That being said, let's get to any questions we may have in chat. Let's see. I'm going to go through it. And Adrian, if you can drop any other questions we have on the other platforms in here, that'd be helpful. Awesome. Okay, I'm not seeing any specific questions. We're a small enough group. If anyone wants to raise their hand, we can take questions. If not, you have the links over here, guys. Adrian, if you can drop a link to my calendar in chat so that if anyone wants to book a call with me, they have a direct link, that would be helpful.
Adrian, you can just use the Springs /Springs calendar. Prom, there's no questions from Facebook.
Okay, awesome. Very good.
So probably stem from the fact that our entire presentation was questions and answers. We might have stolen
That's
some
true.
thunder from some of the audience here.
That's true. But hopefully it was educational for those of you, and then again, more than happy to hop on a call with anyone on here. But it is 5 minutes past the top of the hour, so we can hop off after this if no one has any questions. Thank you guys for spending your evening with us. Thank you, Tommy. Thank you, Adrian.
Thank you, everyone, for jumping on. There's also a webinar replay on the Houston 5, gwcapital.com Houston 5, if you want another take on the investment there.
And hopefully this answers a lot of your questions. Hey, Esther. Hi, Audley. Let's see who else did I not say hi to. Hi, Mike. Okay, thank you, Tommy. I'm gonna end the meeting.
Sounds good. Thanks, everyone. Have a great rest of your night.
Take care.